Hello everyone, this is Paul from the APN Academy, and in today's video we're going to be speaking about breakouts. Now, it doesn't matter the type of trading you do or you've been doing, whatever the method of trading you're using to do your trading. At least at one point, you've either come across breakouts or you've expressed breakouts or you've actually used them in your way of trading. Now, this is what we're going to be speaking about today, so that you can understand in detail how you can go about it, how you can capitalize on breakouts, either by trading it or by utilizing it to exit your trades that you've already taken, right? So without wasting time, let's just get into it, right? So let's first understand what should the market be doing for us to start even thinking about that a breakout should happen or should come to our minds, right? One, the market should either be trending, right? The market should either be trending or the market should be consolidating, or you can say that the market should be ranging. Now, let's first go deeper into this a bit, right? Now, what do I mean by the market should be trending? Let's first start with the trending part. So we know that we have two types of trending. We have when the market is trending upwards, and also we have when the market is trending downwards. But I want you guys to see when the market came, well, let's assume the market is going down. The market made this low here, then went and made this high here. But I want you to see this. The market further went on to cross this low that it had made. Now, the process of the market crossing this low is what we are calling a breakout. Are we together? So today we want to understand how can you capitalize on that process of crossing. Are you going to join the market in that movement when it is crossing and going down? Or are you going to wait for it to come back to this point it has broken? We're going to be looking at those rules, right? Then also in an uptrend, we have a market which is going up, creates this turning point, then comes down. Then again, we cross this turning point here, this turning point. Let me just highlight them for you. These are the points I'm talking about, the process of crossing these turning points here. The process of crossing these turning points. This is what we're calling a breakout. Breakout is simply when the market is crossing. Now, for us to experience these breakouts, we have said we're starting with the trending markets. The market either has to be trending. Secondly, the market has to be consolidating or ranging. So this is the first scenario. This is the uptrend. This is the downtrend, right? Now, let's look at point number 2 when the market is consolidating. Now, here we're going to have a little bit of arguments, and I just want to simplify for you. When the market is consolidating, it is creating patterns. Let me just repeat that. Put it in your mind that as long as you see the market is consolidating or ranging, what do I mean by ranging? The market can be ranging in a number of ways. And the first way that the market can be ranging is this. One, the market can be ranging horizontally, right? Horizontally. Two, the market can be ranging while printing inconsistent. It's making highs, but it's not making progressive highs. It can also consolidate when making a bit of slanting channel. It can also consolidate when rising in a bit of a channel like this, right? So when the market is consolidating, it is simply creating patterns. Are we together? And what forms patterns? Just be attentive here. I know we are going to disagree, but patterns are simply trend lines. Just two trend lines. That's why you will not hear me speaking so much about patterns here and there, because it is simply trend lines. At the end of the day, it doesn't matter. I normally see traders struggling to cram the names of those patterns. Wedges, this triangle this, flag this, and all that. It is okay to cram them, or even to understand them, it's very fine. But I would like you to make trading so simple in a way that you just want a trend line to be broken, because we have said that they're made up of two trend lines, right? We're going to see all this on the charts, right? So we just want one of the trend lines to be broken, either the downer one or the upper one. For example, if this market is consolidating horizontally, it means that I do have this upper level and I also do have this downer level. Are we together? So it's trapped in between here. Now, we need the market to cross either downwards or to cross upwards. Now, this is what we are calling a breakout. When the market crosses up or it crosses downwards, it's called a breakout. Alternatively, also when the market is consolidating like this, we have trend lines up and down here like this. Are we together? So that's when people come up with their names, that this is a rising wedge, this is a rising channel, falling channel, a falling wedge, something like that. But at the end of the day, we either need this upper line to be broken, trend line, or the down arm to be broken. Are we together? So that's why it's bringing us to the topic that we're speaking about, the breakout. Are we together? So let's also continue. There's also this one up here. There's also this one up here. So if you see something, the market is consolidating in such a way, you just have to mark your two trend lines, right? Up and down. Some people even do not want to have both of them up and down. They just want to have one, just to make it simple for them. Guys, remember, trading is all about making something very easy for you to understand. The moment you start complicating things, it's going to be very, very difficult for you. Are we together? So there are very many patterns. I'm not going to exhaust all of them. Sometimes even the market can be consolidating when it is creating something like this, which people call triangles. It can be like this. Let's just mark it. It can be like this, and then also someone can have the down one like this. But personally, I just prefer having either the down one or the up one, depending on where the market is trending, because these consolidations are normally created when the market is when the market makers are collecting liquidity. So we're saying that one, just a small recap, one, the market should either be trending or the market should be consolidating for us to experience a breakout. I don't know if I'm making sense. If I'm not making sense, just slow down the video, and or you can just repeat it so that you can understand it in a better way, right? So now let's continue. Having understood the situations or the scenarios where we want the breakouts to happen, let's continue. But exactly what is a breakout? Now, I've already mentioned that a breakout is the act of a price crossing a key level. Now, a key level in this case is for those two scenarios. When the market is trending, we want either high or low to be broken. We already mentioned something like this. That when the market is trending, we're making higher highs and higher lows, or when it's trending downwards, we're making lower lows and lower highs. So the process of the act of breaking these turning points here, this is what we're calling breakouts. Are we together? So we're calling them key levels. Why? Because we say turning points are very important in us making decisions. So it's a key level. The same applies here. When the market breaks this low here, we're broken a key level. Are we together? So we're saying that breakout is when price is crossing a key level area, or what we can call area of value, right? So let's continue. And a key area, like we've looked at earlier, it can be either a horizontal line or a diagonal. Now, in diagonal form, we're talking about trend lines. If something is diagonal, we're using a trend line to make a diagonal line. So it can be a diagonal or it can be horizontal. You can also have it as a slab, right? Some of you use horizontal lines, or personally, I prefer using slabs, but it doesn't matter, right? Now, where do we find breakouts? This one I've already looked at it. When the market is consolidating, I've already given examples there. Some of you call them flags, wedges, peanuts, and all that. I don't want to go into those names, but I've already given you a simple way. We just want, even if it is a rectangle or a triangle, we just want one of the trend lines crossed. Or if it is a horizontal, the market is trapped in here, we just want either broken upwards or broken downwards. Are we together? Then also support and resistance. For example, if the market went up, created a turning point, came down, created this turning point. So this is a resistance, this is a support. Are we together? So when the market comes back to this resistance here, by definition, we expect sellers to come into the market. But the moment the price crosses it, we have said that here we are crossing a key area, definition of a breakout. The moment price crosses it, it means that we're having a breakout. Are we together? But that's not all. Just be patient. We're going to come to the rules, because this breakout has affected most traders. Some of them are being trapped. Some of them are experiencing what we call false breakouts, which we're going to speak about in the next video. But today we're just looking at the rules of breakouts. How can you be able to capitalize breakouts? There are two types of ways you can capitalize on these breakouts, and we're just going to look at that in a bit, right? So this is how breakouts happen on support and resistances, right? So if it crosses this resistance here, we're having a breakout. Also, when price comes and bounces off from this resistance, and then sellers come into the market and reaches here, we expect buyers to come into the market. But the moment buyers do not come into the market, but rather the price crosses, or what we call a breakout, right? When the moment the price crosses this, that's when we're experiencing a breakout. But now the question comes, once you experience a breakout, how are you going to deal with that as a trader? Now, this is when your personal choices come in. I'm just going to give you the two scenarios, right? So, one, let's look at the rules of these trend lines. Let's first look at the rules before I can tell you how you can deal or how you can trade these breakouts. Now, one, let's first look at the horizontal scenario. For example, price comes and starts consolidating in this within these two. This is a resistance and this is a support. Now, when price crosses upwards, right? First, we need this crossing to be with momentum. Now, momentum, what do I mean by momentum? We need that the candle that is crossing this should be a big candle. We have already spoken about watching how price or how the candles approach a key area. For example, this resistance is a key area in this case. So the candles approaching this area or breaking through here should be aggressive, should be with energy. The candles approaching this should not be small candles. They should be big candles that are crossing. Are we together? That's what we mean by momentum. So the break, there should be a break with momentum. The break should not be weak. We're going to look at all this on the charts when we're doing it practically. The same applies when the market is crossing downwards or breaking downwards. We need it to be with momentum. In a layman's language, we can say that we need it to be with big candles, right? Big candles, big sell candles are communicating to us that sellers are strong in the market. Are we together? Then the second rule is, which most people tend to ignore, is that we need a weak retest. For example, let's say I have my trend line and the market has been bouncing off it, right? Now, the day we break above this trend line here, are we together? We need a weak retest to this area. Now, sometimes the market is not going to give us a retest exactly to this trend line here. Now, that's what most traders tend to misinterpret. You're not going to have a retest up to this trend line. Sometimes we're going to have a retest on a broken structure and then it continues up. Sometimes when let's say, for example, let me just use an example that is a bit clear. If the market breaks this resistance, for example, so much aggressively, we may not come back up to here. If this is an aggressive movement, it implies that we're going to use what we call Fibonacci retracement tool, that the market may not retrace up to this area that has broken, but it may stop on one of the fib levels and then continues up. So do not cram that. Since we are saying a weak retest to the broken level, it's not a must that it's going to come back to that broken area. Are we together? Let me just repeat that. The market may break a key level. Sometimes it's going to come back to it. But the retest or the coming back, what we mean by retest is when the market crosses above and it's coming back to that broken area or crossed area. That's what we're calling a retest. Now, the retest should be weak. For example, if the break was very strong, we need the retest to be very weak. The candles coming back to retest should be smaller than the one that was breaking. That's what we mean by weak retest. Or the momentum should be low, right? So the retest should be very, very weak, but also I'm emphasizing that sometimes, let me just clear this and I re-emphasize. I'm emphasizing that sometimes when this level is broken, right, aggressively, for example, the market may not come back up to this broken level, but rather we can now bring in the aspect of the Fibonacci because it's an aggressive break. So the market may not have to reach up to down, but to stop on one of the fib levels before continuing up. Also, the market can alternatively, when it is breaking, it can create, let's say when it is breaking, right? When it breaks up aggressively like this, it continues up and creates, it can create here what we call a foreign body, or it can create what we call a high here. It breaks aggressively instead of coming here. Gives a small presence of sellers come a little bit and continues up. So in this case, it has created for us a high that the market could retest, or this low that the market could retest. Are we together? So that's why I'm saying that you should not cram that. Most traders have crammed that when a level is broken, the price has to come back to it here. That's how most traders are missing out on trades. And I would like you guys to avoid that. Are we together? So when you're trading breakouts, there are two things you have to be looking at. One, the momentum when the market is breaking. Then two, the retest should be weak. But I've also put a disclaimer or a note that it's not a must that the market will come back to that broken level. So what are you going to be looking at out what are you going to be looking at to determine whether the market is going to come back to that broken level or it may not reach that level. One, if there's an impulsive move during the break, that's one. Then two, if the market creates a structure after that break, that structure is going to act as support, and it's going to act as either support or resistance depending on where the breakout has happened. If the breakout is happening upwards, it means that structure the market has created is going to be a support. If the market is breaking downwards, it means the structure is going to act as a resistance. So there are higher chances the market may ought to go back and retest that key level. Are we together? So that one brings me to the aspect of, if you're going to be trading breakouts, how should you position yourself? Now, you have to choose. For example, if the market created this turning point, came down, and then we broke upwards. Now you have to choose, are you going to trade this retest, or are you going to, this is one, or are you going to trade the continuation? This is two. The same applies for a downtrend. If the market is going down, creates this low, then breaks downwards. So you have to choose as a trader, are you going to trade this retest? This is one, or are you going to trade the continuation? Are we together? Please, 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 if you're a beginner or if you're not very well conversant or you've not traded for long enough, I'm going to suggest you avoid these retests here. Always continue with the trend. But if you're experienced and you understand change of trend very, very well, which we're going to be covering in our upcoming videos, that's when you can be able to trade these retests here. But as long as you're a beginner and you don't understand what change of trend is, avoid these retests and continue with the trend. Wait for the market to come here and then you continue. Or alternatively, if it's an aggressive move, that's when you can bring in the retests. The Fibonacci retracement tool. For example, if the market broke, this break is so aggressive, you can now bring in a fib. You draw your fib here, mark the fib levels here. So you look for change of trend in one of these fib levels and you continue, right? But now also here, you can clearly see the distance is normally short. So if you're not experienced, avoid retests. So those are the two ways you can approach breakouts. One, you can either trade retests or pullbacks, what we call pullbacks. Then two, you can approach it breakouts with the continuation. Those are the two ways you can trade. So you have to choose one depending on your experience in the market. Now, all this has been theory. Let's try to go to the charts and observe exactly how we do this practically. Okay, so let's try to look at the practical bit of whatever we've spoken about in the theory. That's our usual way of doing things. We start with theory and then we get to the practical bit so that we can understand it practically. Trading is practical, not theory, right? So let's try to use this CAD JPY on this move upwards. I don't know where we can start from, but let me just let's try to use just the whole move, this whole move. Now let's try to identify the things we've spoken about. Patterns, what you guys call patterns, but personally I look at them as just points of trend lines, two trend lines, and our support and resistance. We're going to look at the aggressive moves and all that we spoke about in the theory bit. Now, let's start from down here. Let's first mark out all the points. For example, I can see what someone would call a pattern here. Don't worry, we're going to adjust them. So we have this pattern. Now, why I emphasize that you guys should not cram is, in books, it is written that after this drop down and then consolidation, we expect a drop down. What happened? The market went up. So that's why I'm telling you guys, do not cram. Just wait for the market to break, right? Do not cram those things. So we have that. Then also, I can see that we do have here something like a trend line here. We're going to adjust them. Then also we have an aggressive move here, but alternatively also someone can have this trend line here. Plus also we have a structure here, a W. So we have an impulsive move here. Let's work with these ones for now. So we're going to go to the structure and look for the breakout, and then we see how we can take the entry, meeting all the rules that were spoken about in the theory part. So without wasting time, let's just start with this first one here. Let's start with this first one. So this one gives us a pattern. I don't know its name. I don't know if it's a triangle, a peanut, or a falling wedge. I don't know how you guys would call it. So, of course, personally, I will just take it as trend lines, and then we now know the rules of drawing trend lines. We have a whole video about it. So this is a pattern, right? And what are we interested in? We're interested in the market breaking out. Now, I want you guys to observe something. What the rules that we spoke about. The market crossed this trend line here, right? Breaking this structure and then this structure. Now, I want you to look at the way it retested. The retest was not so strong. Are you getting it? The market crossed with a big candle, and then, of course, it lost momentum because it wanted to come and retest, right? And I want you guys to observe what it was retesting. It was retesting this broken structure, and also this is an impulsive move. Why? Because we broke 1 turning point, 2 turning points. So it's an impulsive move because the market bought for 3 days. So here, as a trader wants to have a lot of confluences, what are you going to do? You can just also bring in the fib in case you want, because this is an impulsive move, right? When I just increase the size, you can clearly see this is an impulsive move. So you can bring also your fib tool to give you a better confluence. So from down up to up here, and then we're going to mark this is our golden ratio. And then we're going to also mark these structures here, which is aligning properly with some of the fib levels, right? So now let's go to the entry time frame of daily, which we're going to use H1. So I'm going to just replay here. Let me just bring out the replay tool, and then we remove this so that we can observe how we'll take the entry here, right? So let me just play. So the market came down here. Now let's go to our entry rules, and then we observe how you take the entry on such a trade, right? So when you come to H1, what do we observe? We observe that the market came back exactly into this area here. We have the breakout. We have seen the confluence. We broke structure. This structure here, the blue slab was the structure area. This structure area here. We wanted the market to come back and retest it, but also we have the confluence of the Fibonacci retracement tool. Why? Because this was an impulsive move up, this move here. So now we want to take this buy, right? And as usual, I told you guys that you take a trade with 1 to 3. Your stop loss, if for example, if your stop loss is $10 away, your take profit has to be $30 away. In that way, in the long run, even if you lose many trades, but the winning trades the few that you've won will cover for the losses, and eventually you have a net profit, right? So we do have a market that was creating lower. It created the low, lower high. We had the low, lower high. So what are we interested in? We're interested in the market taking out. So someone can either say that I'm going to take my trade from here, or someone can say that I'm going to take my trade after the market crossing this area here. So it's up to you. Now the market crossed up here. Someone can say that it's going to take a trade from just after the market breaking here. The rules are the same. You can clearly see the market broke up here aggressively and then came back to retest this area in a weak way. So your entry is just going to be above here after the market crossing. Just check the aggressive market here. So we want a 1 to 3. I'm just going to put it there because my stop loss is just going to be below here. So I want a 1 to 3 there. So when the market gets up here, we shall also have another entry. So let's try to see how the market played out, right? So, sorry, your entry is just here. Here. So let's see how the market played out. So when we reach up here, also you can take another entry after the market crossing this area, because also this is an area that was of interest. Why of interest? Because it is a previous turning point. See this turning point, even the market retested it here. So when you break above, it's giving you another opportunity to take a trade. So also this can be another entry. Your stop loss can just be down here. Then you want a 1 to 3, right? You want a 1 to 3. Sorry, the 1 to 3. So your first target was hit. This first target was hit. So we're left with the second one. Let's see if we also hit it. Also, the second one was hit here, right? So this is how you do use breakouts. In this case, we had a pattern, but I've already showed you that you do not need to cram, because here most people, they would cram that since this pattern is written in the books that it's supposed to be a continuation downwards, they would be waiting, or they would be looking for sales here. But instead, what did the market do? The market instead broke upwards, right? So please do not cram if you want to be making minimal losses and maximizing profits. Do not cram, right? So let me just remove this. So let's go back to the daily time frame. Now let's come to the second pattern. We have looked at this first one. So let's try to trade this second one here, whereby the market also gave us like a trend line, right? This time it is a trend line, just a trend line. Now the market gave us this trend line here. And here, I want you to observe here, the market did not break this point here. It came and tried to reject. But where did the market break from? The market broke with this candle here. And then it continued going up. This shows that the buyers are showing having control in the market. Are you seeing this? Right? That continuation upwards. The momentum of approaching this area, look at the candle that approached. It was big, small, big, and then the buyers continued going up after even crossing it. It shows that they have presence in the market. Now, also, this is an impulsive market. Are you seeing this? So, meaning also you can bring out the confluence of the Fibonacci retracement tool. So, we're going to draw our Fib from down here up to up here. And then we're going to mark, you can mark your Fib levels up to the golden ratio. So, these are the Fib levels that we're interested in. These ones here, the market to come to. So, I'm just going to mark the broken structure here, which is aligning with the Fibonacci. And then we want to go and look for the entries in the smaller time frame, right? So we can clearly see there was a break, and then look at the retest. The retest is very weak. Let me just increase the size for you to see. Are you seeing the retest is very weak? One buyer, but even all these sellers could not take out this buy. So meaning that it's a weak retest. So let's just replay, and then we go to our entry time frame so that we can try to see how we can utilize this trade. So let's just go to our entry time frame, which is H1. It should not a must that you should use H1, but I do advise H1 for intraday, and you can refine it further into smaller time frames. We're going to talk about refining in our upcoming videos. So we're interested in the market coming to test this area or the Fib area. So let's play. It's coming down. So of course we have a strong level here, this area here. So, but want the market to come down. So we finally break it, right? So we want the market to come and retest this area and then give us a way to enter, right? You can clearly see it came, retested this area, and then came back down, right? So when the market retested this area here and then broke above this area, this is your first entry. Are you seeing this? The market came, rejected, came down until it broke up. So this area which has rejections is where we're going to be interested in. So the market broke up, and then by it coming back down here, that's our entry point, right? So I'm just going to take my trade here, and then my stop loss will be below this first point here. So this is the first entry that we are having, 1 to 3. Right? Let's have a 1 to 3. 1 to 3. And then we can also have the second entry when the market takes out this area here. When the market takes out this area, you can have your second entry just above here, right? So let's see if we shall hit stop loss or take profit according to our entry. So the market again broke above this area, and on the retest, let me just, on the retest is when you take another entry, right? On this retest, we shall be taking another entry here. This is another entry that we have, 1 to 3. So I just want my stop loss to be below this structure here. Let's see if we shall hit take profit or we shall hit stop loss. So we had a bit of a drawdown. And then we went into profit. Okay, let's see if we shall hit stop loss or take profit. Right. Let's see how it plays out. Now, the first trade, we have already won it. This first trade here, the first entry here. Now, let's see if the second one also we do win it or we shall hit take profit. Here, I want us to observe the entry, right? So we also won the second trade, right? So this is how we do utilize breakouts. We are following all the rules. The retest should be weak. I just want you to observe something here, right? The breakout was strong, but I want you to look at the retest. Just 4 candles breaking, but look at this. I don't know how many candles were here, but failing to still take out the 3 candles. Let me see, 1, 2, 3, 4 buyers, but how many candles here that could not even take out the buyers? Or even alternatively after the break, 2 candles, but 1, 2, 3, 4, 5, 6, 7, 8. This shows that the buyers are stronger than the sellers. This is what I mean by a weak retest. Are we together? Strong break, weak retest. Strong break, weak retest, right? 3 candles retesting here, but still not taking out that area. Are we together? This is what I mean by a weak retest. Are we together? So that's how we do utilize breakouts, right? Now, in these examples, we're just looking at the market. We're looking at trading continuations, right? Trading pullbacks, we're going to be talking about that in a different video so that you guys can get a better understanding of trading pullbacks, because pullbacks need people who are a bit experienced. If you're not experienced, like I mentioned earlier on, you're going to lose a lot of money, right? Because trading pullbacks means that you're going against the trend. Are we together? So this is the last example that we can look at, right? This is the last example that we're going to look at. The market created for us a big W, right? And then broke this structure here. Are we together? We broke structure. Then also we had a confluence of this trend line here. The market broke the trend line and retested it. So in this case, we're going to first have this, we're just going to first look at this, the break of a trend line here, right? So we just want the break, an aggressive break, and then we want a weak retest, right? So you can clearly see we have a structure that has been created here. So on the retest of this structure here, we want it to be a weak retest. So we're going to observe that from our entry time frame, which is going to be H1. So we want the market to come back down here to this structure. It may not come back exactly to the trend line. Actually, your first entry can actually be here. So we want our first entry to be here, and our stop loss is just going to be below this area here, just below here. Then we want a 1, 2, 3, right? Want a 1, 2, 3. We just put it down here. 1, 2, 3. So let's try to see if the market will fill us in. If it will take us, it will take our entry and we take profit or we hit stop loss. So the market filled us in and went in a drawdown, right? So let's see if we hit take profit or stop loss. So we are still in a bit of a loss, but it's okay. Do not panic, because overall you're going to always win as long as you're maintaining your risk to reward ratio of 1 to 3, right? So let's see how it plays out, right? Let's see how it plays out. Let me just extend this. Sorry. Okay. So we did hit take profit here, right? We hit the take profit here for the first one. Now, also remember, we have this big slab. Now, we want the market to come back we want the price to come back into this area. When it comes back into this area, we're going to take another trade because we have an aggressive break. Let me show you in a bigger time frame. We do have an aggressive break. Are you seeing this aggressive break? So we need the market to come back and give us a retest into this area here. Then we can take another trade. So let's just go back into our entry time frame so that we can observe that retest, right? So let me just delete this. So we want the market to come back down to retest, to give us a retest here, and then we can look for another trade. So it gave us a lower high. So let's try to see if it will come back down here. Okay. So the market came back down here. Now we want to see it giving us an entry. So let's try to see, created this high, right? So if the market goes above this area here, we're going to be taking our first entry, right? So let's see if we go above that area. So this is the first time that the market broke this area here. Now, when we come back here, now this is an aggressive push up. So we're going to have two entries actually. We're going to have the first entry here and then the second one here. Are we together? So let me just put the first entry here, 1 to 3. Our stop loss can just be below this area here. We want a 1 to 3, right? We want a 1 to 3 there. Then the second one can just be, our second entry can just be in this area here, still a 1, 2, 3 there, right? So let me just increase the stop loss below this structure. And also this one, this first one here, also the stop loss has to be below structure here, below structure here. So we can just increase this to 1 to give us a 1, 2, 3. Let it give us a 1, 2, 3 here, 1, 2, 3. So let's see how it all plays out. This is our last example. So we want the market to come and give us our entry here into this point here, right? So let's see if it will fill us. If it doesn't fill us, then we shall have missed out on the trade, but it's always okay. Even if you miss out on the trade, it is fine. Do not chase trades, right? So, sorry. So the trade filled us in. Let's see if we hit stop loss or we hit our target. So we went into a bit of a drawdown. So it has filled us on both trades, right? Let me just adjust this. It has filled us on both trades. Let's see if we shall actually hit the targets. We almost hit stop loss, but of course we are protected by this structure here. That's why I said we put the stop loss below structure. So let's see if we hit targets for both or it will come back down against us. When it hits us, it's always okay. Right, let's see if we hit our target. So we hit the target for this other first trade here that picked us from down here. Then it came down, right? It came down. Let's see if we shall hit the target for the second trade. Let me just adjust this. This is our second trade. It's still running. While this first one here, we hit our target. This first one here, we already hit target from here. So let's see if we shall hit our take profit for the second trade or it will hit our stop loss, right? Up, in case you protect your trades and you're taken out, you can always look for another entry, right? So because some traders tend to protect or to break even, so if your break even is kicked out, you can just take the trade again, right? Now, me, I'm a swinger, so I do not like putting break even and protecting the trades. But in case you're an intraday trader or a scalper, make sure you always protect your trades. It's only a swinger who can, because a swinger does not mind how the trade fluctuates, but they're focusing on where the trade is going, right? In this trade, we hit stop loss, right? This trade we hit stop loss. The first one gave us our take profit, but the second one we hit stop loss, right? So personally, I would have lost the second trade, but I would have won the first one, right? So overall, you can see I would still be in profit, right? Because I've lost a certain amount of money, but the first one I did win it, right? So always make sure you keep at least the minimum risk to reward ratio should be 1 to 2, right? This is how we do apply all the rules that we've looked at back in the theory slides. So I hope you guys have learned something out of it and you can back test it on your end so that you can see how it suits you, right? But you can apply this on every type of market, right? No matter the type of trader, a breakout is a breakout, right? So if it was your first time coming across our videos, make sure you smash that subscribe button and turn up the notification bell so you do not miss out on the upcoming videos, right? And also, if you found value in this particular video, do not forget to click the thumbs up button or likes button so that also other people can come across it. Thank you and have a great day.